I closed an Amazon put credit spread today for roughly 50% profit. So we're going to rinse and repeat, and I'll show you how to redo this deal. So I'll click on the little feather there. That'll take me to the Amazon stock, and we'll click on trade options. And today is the December 26th. So we want to go out at least a month and a half. Maybe we'll go to February. You can see we have sell and put selected, and share price of Amazon is around $233 right now. We want to go below that. And I'm looking at the chance of profit, and ideally we'd want to be somewhere around 85% profit or better. And so I'm going to keep that number in mind. I'm going to keep that strike price in mind, the 205. That's my target of my target strike price for that chance of profit. So we'll keep that in mind. So let's go back to this builder. And let's say we want the stock price to go up in the future. And then I'll scroll down to a vertical spreads, click on put credit spread, and go to our same expiration date, which was February 6th, 42 days out, perfect. The width, they won't give us $2.50 width, so the smallest they'll give us is $5 width. So we'll click submit, and we'll scroll down to the 205, and we can see that the highest strike price is the 205, which is the one we're interested in, and we'll click on that. So you can see that our max loss to max profit ratio is about 9-to-1, which is normally high for me. Normally I like to have a ratio of 4-to-1 or better. But on the other hand, this stock would have to drop 12% or lower before I start losing money. So this has a higher probability of profit. So that's the trade-off of accepting that higher potential loss, because this deal is more likely to happen and more likely to have some kind of profit. So I've been having success recently with accepting that higher max loss to max profit ratio in order to get that higher probability. And so I'm okay with this. You could always bump up your credit spread to a higher strike price closer to at the money in order to get that ratio of getting like a juicier profit compared to how much money you're risking. And you're welcome to do that, but this has a higher probability of profit and I'm okay with it. So we're gonna go ahead and click continue, and we'll click we'll go ahead and enter the price here. Medium fill likelihood, this is the money you'll receive for getting into the deal. Maybe we can bump it up a little bit. Now it says low fill likelihood, still low, so maybe we'll take 50. We'll try that. Risking $500. That's the collateral we're putting up to get into this deal to make $50. Pending, filled. Awesome. So now I have a put credit spread opened up on Amazon. So the next thing I'm going to do is we have that strike price of 205. We don't want it to dip below 205. So what I'm going to do is put in a price alert for maybe, let's say 210. So let's go back to the stock and click on the little bell, and we'll say 208. That works for me. We'll turn that on. So if the price moves below 208, it'll give me an alert, and then I could decide whether I'm going to close the position, let it ride, maybe roll it out. We'll just have an alert to reassess this put credit spread if the price starts to move against us. So that's how you open up a put credit spread on a stock in the Robinhood app. So thanks for watching. If you like this kind of content, please give me a like and subscribe, and I'll see you next time.